Welcome back, everyone, to another Market Conversations. I'm Jerry Hall, broadcasting from beautiful Costa Rica. And as you can hear my church bells in the background, you know it's time to have a great live stream. I am absolutely excited that a friend of mine, John Polomny, a fellow YouTuber, is going to be joining me. I found John's YouTube channel back when I was really doing deep dives into trying to understand the broader capital markets. And John just connected. I just connected to this young man. The context, away from the actual content, was always about providing information so that I could become a more knowledgeable investor and therefore produce better outcomes with my investment dollars. I've always appreciated that about John. And so I was very excited when he graciously accepted my invitation to join me tonight. I'll take a quick, I want to say hi to Al, P. Kelly. Hey, Rob from Digital Asset News. I was going to talk about you in a minute, but now that you're here, well, I'll talk about you anyway. I was going to recap for you guys real quick the week that I had following some content. I caught some stuff on Real Vision that I just found remarkable. They had an interview with an actual digital asset market maker, and he broke down in great detail the dynamics of that market. And I gleaned some insights that I think are going to help me with future allocations in digital assets because of the nature of the characteristics of those assets. I listened to a crypto Airy video where she talked about FX Coin and their partnership with the largest bank in Japan, MUFG, as well as SBI and B2C2, the globe's largest OTC desk for XRP, and the experiment that we're running this November, settling FX contracts, swap contracts using XRP. Exciting stuff. Saw 3 digital asset news videos this week and commented and loved every single one of them. Rob, you've been hitting some home runs lately, young man. Keep it up. Also, today, unbeknownst to me, because John had already agreed to come on the show, John Polomny put out a video on his channel, link below, where he talks about success leaving clues. And he goes into Bob Farrell's kind of rules for investors. These are incredible things that each and every one of us can put in our toolbox, add to our thinking process, and the next time we pull the trigger on a trade or an investment idea, we may very well influence the outcome because we're making better decisions. And at the end of the day, that's what it's all about. So without any further ado, let me bring in my friend, John Polomny. Hey, John, welcome to the show.
Good evening, Jerry. Thanks for having me.
Right on. So why don't we start with, why don't we talk about your video that you put out today? I really liked it. I thought you did a great job bringing the context and the principles of what Bob Farrell had put out all those years back. Want to speak to that? I thought it was wonderful.
Yeah, so one of the things that I try to do is go to bed, as Charlie Munger says, go to bed wiser than when I woke up in the morning. So, I've been doing this investing and speculating for 30 years now. And when I initially started, I made a lot of mistakes and my results were inconsistent. So I finally decided to assess what I was doing. And what I did was look to the people that have been successful and see what commonalities I could find or find something, glean information from these successful people. And I started seeing common denominators, common things that successful investors throughout history, not just in recent times, shared. And Bob Farrell was a guy that the article, you can just search online, it'll come up because they put it out. It's so its timeliness doesn't go away, so you can see it, the rules. But basically, what I say is, success leaves clues, and the wisdom that people have learned from giving their own, suffering their own losses and learning. They say experience is the best teacher. So why go through the exercise of making all the mistakes everybody else has made when you can just look at the wisdom? Because we're human beings, in human nature, it doesn't really change throughout time. The same mistakes are made over and over. We can trace back bubbles. We could talk about the tech bubble, the housing bubble, the Nifty 50 bubble. You keep going back in time, the Great Depression, the stock market bubble then, South Seas bubbles. All these things happen over and over and over again. So what I try to do in my channel is try to get people to think so that they can become better investors and better speculators, and not make a lot of mistakes that I made earlier in my life, because time is the most valuable resource you have as an investor. You want to compound. You want to have your returns compound over time. And if you are not being consistent, you are losing time, and losing 10, 15, 20 years until you finally, a bell goes off. It's probably a lot easier just to learn from others early on. But that's the basis of those type of videos.
No, I've gleaned a lot from your work. And as a matter of fact, I thought what might be kind of fun, I've never done this before, but I am the trustee or actuary of an investment account for my 11-year-old daughter. And I have an allocation for her. She gets one every Christmas. And one of the things I was thinking about, because it's so important for me, because she's so young, that the assets that I have in there for her have strong compounding components. In other words, they pay it, the price I'm locking in the stock at the time locks in a good yield if the dividend structure stays relatively the same, to take advantage of her youth. And so one of these such, theses or investment ideas that I had that I thought I'd want to do, because I've already got her in a digital asset thing, and I don't want it to all be digital assets. And I was looking through the different various asset classes and subsectors and commodities, and I think I've settled on oil. And I'll tell you why I'm saying this. I think oil is a depressed market currently and will rebound with some finality to this COVID weirdness. Now, that's the basis of my thesis. I think oil will rebound once we get through this weirdness. I think people will travel again. I think mobility will pick up greatly around the globe. Therefore, the demand for oil will go up. Therefore, how do I want to express that trade idea? And I was looking into various oil companies, and I came across one that I thought represented my best chance for upside potential of capital appreciation, as well as solid dividends for now going forward, looking at their past history, And that company is Valero. Are you familiar with them?
Yeah, they're a refiner and marketer. I'm basically familiar with them. They're big down here in the Southwest and in Texas. As a matter of fact, they have main refineries are right in Corpus Christi, right north of me. Yes, I'm slightly familiar. Yeah.
And because they do have refining, retail, and believe it or not, exploration, specifically out of, believe it or not, all places, Venezuela, I think there's upside there. Now, if I were to take a look at a oil company with the tools that, say, Charles Schwab gives me, how would I do a cursory valuation on a company like this? How would you approach valuing this company?
Well, first thing I would do is open up an Excel spreadsheet and start building a spreadsheet. I would probably a lot of these tools, you can download a lot of the basic financials like the revenues and cash flow, things like that. And I'd probably go back maybe 5-10 years. And I would probably start looking at that, number one. The thing with the refining industry, I mean, I haven't dived it, but one of the main factors that has been taken into account with refining industry is understanding the correlation. I would try to correlate the stock price and previous stock price historicals with something known as the crack spread, which can be tracked. I believe it trades. It's an actual traded financial commodity on I think it's on the NYMEX, New York Mercantile Exchange. But anyways, it represents the differentials of basically the profit per barrel. Is the way I understand it.
Right.
And it fluctuates, obviously, based on demand, based on oil. I mean, there's several things that go into a situation with Valero. I mean, I do know something about the refining industry in the Gulf Coast because I used to work in it. But a lot of the refining here, these type of companies like Valero's the main one, they had a very high advantage because they used to import crude, matter of fact, from Venezuela and Mexico, which are heavier crudes with more sulfur content, and they pay less money for that. So if they could pay less for their feedstock than they can for the crude that comes out of say Canada, which is a heavy oil too, that's pipelined down, or from the Permian Basin, which is a lighter crude, and they're not set up to refine as well, and yet they can still market the gasoline. That's what that crack spread starts representing. So I would try to build a model, basically, and just try to see like the history of the crack spread versus the history of the stock price, and then correlate that with revenue and cash flow, because I don't know what the dividend yield is. I can't really see your chart there.
I'll tell you exactly what it is. What it's stating right now here. I'll go to dividends. It's a beautiful 9.92% annual.
Yeah. So what I can see right here is, and here's the thing I like about dividends, and a lot of people will say the same thing. Dividend, you can mess around with the financials, but when a board of directors decides to pay a dividend, they're attracting a certain shareholder class, and they don't want to raise the dividend 1 year and then 3 quarters later cut the dividend and go up and down, fluctuate. They want to have a consistent ability to pay a dividend if that's what they want to do, to attract a certain institutional element or investor element, and allow that to go up. So that tells a very good story there, that this is a company that has an ability to, and this is going to be based on cash flow. That's another metric I like to look at, because that's the real. Right. You can mess around with earnings, but you can't mess around really with cash flow and dividends and money that's I would also be looking at share buybacks. I think they probably do that. So I would be taking a look at those type things. This isn't really a growth business, if you will, but it is a business that if it's cash flowing properly or nicely, and it's going to be based on demand. To your point, as demand comes back, the demand for refined products will normalize, and they will get back on track with their typical. I mean, because it's a fixed cost business, right? The amount of refinery runs that they do, and right now, the main reason why oil demand's down is mostly because of aviation fuel. So just like you said, I anticipate the same thing, that'll be returning. I want to travel again. I have plans on going to Central Asia next spring, as soon as things open up. So I think other people are the same way. They don't want to stay cooped up in their house. So I think that I think you're onto something there, and that's just how I would model it. I don't know enough about to deep dive it here, but that's kind of what I would be looking at. I would just build like a 10-year model and just have some certainty in my mind. Okay, this is a company that's been able to max. I know that they're they're well regarded in the industry as being a top-notch operator. So it's just a matter of, as demand comes back, will they be able to normalize their cash flows, historical cash flows, and maintain that dividend and grow it at the rate that they have in the past, which is what you seem to be, if you're compounding the dividend at a certain rate over time, that's what you want to see, right? Because that's
the two elements. So that's a huge part of it, obviously. But the primary, no, equally weighted is the fact that when I'm looking at when I'm looking at what like, for instance, crude's going for per barrel, and knowing how kind of beat up the energy sector has been lately, and looking at the previous stock price, it's half of what it was in the end of February. So I'm considering it a depressed asset. So I want a capital appreciation element as well as this beautifully locked in dividend yield. So yeah, I want both. I want it all. You know what I mean?
I would suggest, you've got a couple of things, that are depressing the stock price right now, right? Not only the price of oil, but the whole ESG movement. I mean, the whole energy industry, well, not the whole energy industry, but the carbon-based energy industry is being slandered without mercy currently as this current zeitgeist. So I think that's having a depressing, but these things go in cycles, right? So oil and natural gas, these type of things are integral to our lifestyle. I mean, one thing I would just point out is even during this COVID thing, I was modeling like how much would the demand be affected. And I was thinking, before COVID hit, worldwide demand was approximately 100 million barrels a day. And I thought we would take a 30 million barrel per day hit, and that would cause all kinds of problems. And in retrospect, the maximum effect was only about 15 million barrels a day. And then, we're already back to like 94 million barrels a day of demand. We're only off by about 6 to 7 million barrels. So that shows you how inculcated and integral the demand for oil is, and refined products and plastics and all the things that petroleum products are used for. So yeah. I think that, it's a sediment thing. That's why it's cut in half. And I think you're onto something there. I think sediment will change. Eventually we will go back to some semblance of normal, and demand will come back and continue growing over time. So yeah, I don't think that's a bad punt on your part.
Right on. Well, I love having my biases confirmed by people I trust. So this comes from Rob over at Digital Asset News. Good evening, John. Let's hear some gold info. Let's talk about gold royalty if you can. E.B. Tucker info.
Yes, E.B. Tucker. He is a favorite of mine. I've read his recent book. I've watched a lot of videos. I actually own the stock that company he helped found, which is a royalty company called Metalla Royalty. Outstanding management, people that believe in their product. That's one thing I do like. A lot of people in these resource extraction industries don't actually like or believe in the product that they extract from the earth. He is not that kind of person. So gold, yes, I'm very bullish on gold for many reasons, which we can get into if you'd like. But obviously, currency debasement, instability, things like that, I think are going to drive hard assets and gold higher. Actually, Metalla is more currently has more of a silver bias, but they are increasing their royalties just about every quarter. They keep tacking out. They're very, very aggressive, very streamlined. There's only like 4 or 5 people working there. The revenue per, it's just a terrific company with that's going to do very well, I think, under that management team during what I anticipate is going to be a very long and profitable gold precious metals bull market.
I would definitely agree that globally, there's the bull case for gold, and we are in a bull market for gold for a lot of the same reasons that a lot of people have gotten into the digital asset space, specifically Bitcoin. These are two hard assets that represent extremely high quality collateral for a lot of reasons. What's interesting is kind of the generational divide. The millennials lean towards Bitcoin, and boomers would lean more towards gold, and guys like you and me, they're that Gen X, are somewhere in the middle. I love gold, and I'll tell you, if I had a substantial portfolio that needed protection, because right now, I'll be honest, my portfolio I'm swinging for the fence. I'm going for monster wealth creation. Gold, I don't see as a monster wealth creation device. I see it as a wonderful store of value and protection against MMT. Did I lose you, John?
No. So this is interesting because if you look at the start of my YouTube channel, I started it. This is a good segue for my it's kind of like the conversion process that somebody goes through. So when I first became exposed to cryptocurrencies, look, when we had a initial run up a couple years ago. Let's just use Bitcoin as an example, to $20,000. I started my channel based on a conversation where some people called me on a Sunday morning. As a matter of fact, it was a family member and a bunch of his friends, and wanted me to comment on it. And I said, the fact that you uninitiated people that know nothing about this are calling me and asking my opinion on a Sunday morning when this thing's at $20,000 probably means that's the top. This is the Rockefeller shoeshine boy discussion here, where once the shoeshine boy was giving John Rockefeller stock tips, he went in and not only sold all of his stocks, but the legend is shorted the market right at the top. But anyways, look, we went through the big pullback, and the more I've spent the time looking at it, I read, the white paper. I've done as much research as I'm capable of doing. I mean, you can't kiss all the girls, but I'm becoming increasingly more interested in cryptocurrencies. And, I have a small allocation to several cryptocurrencies. Bitcoin's one of them. What I see happening now is I see increasingly more and more news, more and more things happening that are lining up, i.e., you're seeing these companies like MicroStrategy and some other ones that have taken basically shareholder capital, instead of just putting it in the bank at 0%, not even zero, at negative rates, and just sitting there, they've put it into Bitcoin. And I'm just not going to focus on Bitcoin. I'm just saying this as an example. And now you're seeing a more institutional thing starting to line up. You're seeing Fidelity now. They just put a 90-page paper out. They're going to allow people to they're going to become a custodian. They're going to allow this, and it's going to end up where you're going to be able to do that with your 401k money, IRA. Because what are these institutions really wanting to do? They're all about throwing a net out and getting assets under management. And you're exactly right. There's a generational gap. I mean, if you're a boomer, you're just, Charlie Munger and guys like Warren Buffett, they're just going to tell you that they don't understand it. They don't want to understand it. It's too far out of their circle of competence. Then you have guys like us, Gen X. And then, these millennial people, folks, I mean, they're a lot more savvy, technological prowess, and it's easier, I think, for them to digest. And I think that, the thing that I really like about it is when I started playing around with the different tools, it became very apparent to me that, there's a lot less friction. If I just did a transaction where I bought some assets in a Central Asian country, and the amount of paperwork and paying fees for wire transfers and all these things. I mean, I can see where you get a bunch of smart millennials together, and then, just removing the friction from all these financial transactions, the things that you're able to see with cryptocurrencies, the ability to tokenize assets. You could take a trophy asset, if you will, like Trump Tower, let's just say, and you could literally tokenize that, and people could own shares in it, and you and I could trade those with no friction if we wanted to. Or you could take a Mickey Mantle, gem mint rookie card, and people could own a portion of that or whatever. And you could see all these. You could just sit here for hours and think up different ideas about how this could manifest itself. So yes, I'm becoming more and more interested in it. And what I'm seeing is the institutions now, which is what I thought would be the evolution. You have your normal retail punters, speculators, kind of get things going, your early adopters that are tech savvy, and now you're seeing more institutional money, more governments. I mean, you have Christine Lagarde talking about a digital euro. I don't know how dangerous that is or what that, but you see it's the snowball is picking up speed, I guess is what I'm trying to say from my perspective.
No, it really is. I could not agree more. Here's the thing, and I tell you, I find this extremely painful as well as exhilarating, is that there are a ton of people in the digital asset space giving their opinion. And that's fine. There's nothing wrong with people giving their opinion. But there are very few giving solid, just information, right? Rob from Digital Asset News is not a tribalist guy. It's not Bitcoin or nothing. It's not Ethereum against Bitcoin. It's not XRP against this, or, you know what I mean? He's got a pretty vast portfolio. He's bringing news of the day. He gets some really good guests on, and it's a well-produced show. And there's probably 6 or 7 guys like Rob in Digital Asset News that have that kind of channel. Then there's a whole bunch of tribalists who are, they're basically saying what they're talking about is what's happening. The rest of it's shit. I fall more on the non-tribalist side. I look at projects that have use cases, that have teams. I try to value them like stocks in a way, look at partnerships, look at, what's their path to production, what's their path to profitability, path to adoption, whatever the case may be. And I'm excited. It's been a long road for me. I've been in this space since February of 2018. And so I've, basically got in on the decline and watched it just go down. And I kept thinking to myself, okay, I get this. This is what it was like in the mid 90s when I could easily see the value of Amazon, but the world said they're not profitable. They suck. The sentiment was horrible. Yet I'm watching companies like Netflix come up, and now I don't have to go to Blockbuster. They'll mail me the DVD. And then I read something, they're going to start using the internet, and I can just plug into their channel on the internet. I don't need a disc. I'm thinking this is the greatest thing since sliced bread. All I got to do is remember when I go to the store, buy the popcorn bags that I can throw in the microwave. The computer will handle the rest, right? Yet nothing in the market. The market didn't think these things were that valuable. Now look at these companies. Technology has provided the ability for the use case to really flourish and open up. Now everybody has a PC, not in their home necessarily, but in their pockets. Who would have thought of that 20 years ago? That you'd have a fully functioning mega computer in your pocket. But here it is. And now it opens the door to all these things. I see digital assets being that the internet was for information. Only digital assets will do it for finance. Okay, we've got hurdles. There'll be adoption hiccups. There'll be all kinds of stuff. But there's no stopping it. The genie is not going back in the bottle. This is for real. You want to take a minute and answer some of these questions for you?
Yeah, it's fine. I mean, if you pop them back up, I was
trying
to listen to you.
One. Institutions are coming hard. It's difficult not to when MicroStrategy made $100 million in 2 months after the initial investment of $425 million. Here's another one. John, my question is this. We both agree that gold is a great investment and Bitcoin digital assets are great too. Monstrously great investment. So why then to gold bugs, Peter Schiff, to miss it? Yeah, why do you think guys like Peter Schiff are saying Bitcoin's horrible? Bitcoin's stupid. It's going to go zero.
Well, that is, I mean, this was Rob, right? So
yeah.
Peter Schiff has $100 million a year business based on gold. I mean, and selling gold, selling things that are wrapped around gold. And Upton Sinclair, I think, said that it's hard to get a man to change his view when his livelihood depends on him not changing it. I mean, it's just human nature. It's just biases. It's one of the things I talk about in my videos that, so people are biased towards a certain view sometimes, and they just can't get off it. And, there are some legitimate questions I think that have to be answered. One of the things that has to happen, in my view, and I think institutions won't have a problem with this, but I'm seeing more and more of this. It's happening in the background, and you guys probably, I'm sure, know more about it than I do. It has to become easier to transact, to hold, there's just the perception for, I'm talking about for mass adoption, in my view, or for
right.
really, that, and I know that's happening, but I think that's one of the hurdles. I do angel investing also. There's a couple of deals I've looked at where people are actually trying to, or organizations, companies are trying to do these things to make, to your point, just to be able to get on here like you can on your Ameritrade account or your Schwab account and just trade Robinhood or something like that and make it that easy. And I think the horror stories of the initial, it didn't help. Like today, you had that article about Silk Road, the government, $1 billion worth of Bitcoin.
The of some of the Silk Road Bitcoin, right?
And we all know the story behind that and the illegal activities, but that's part of the perception, right? I mean, so I think that making it more ubiquitous, making it more easy to transact in, lowering some of the transactional costs, which can be high in some cases, but I think the die is cast, and it's going to, like you said, it's just going to gain more momentum. And I think your analogy is excellent, because you're exactly right. When Amazon first started, it was ridiculous. I remember thinking to myself, this company doesn't make any money. Why are people buying this? And you see where it is now. I mean, it's several $1 trillion in market value. So. One thing I want to point out, I listened to a interview with John Hathaway, just as a side note, who used to run the Tocqueville Gold Fund. It's now under Sprott, and he was being interviewed by Jesse Felder, I think. But anyways, he pointed out something about gold, and I think this is even more pertinent to cryptocurrency like Bitcoin, for example. Hathaway said there's about $100 trillion of assets under management worldwide. $100 trillion. If $1 trillion tried to go into the gold market, the market would not be able to clear. And what he meant by that was the price would go up so far that you wouldn't be able to buy, you wouldn't be able to put 1% of the assets under management into gold. Okay. And I think with cryptocurrencies like Bitcoin, my friend Harris Kupferman, who runs a hedge fund, some people might be familiar with him, he wrote an article on his site about this because he doesn't share our view on it. He thinks it's more of a speculative vehicle. But what he's saying is that the institutions and even Grayscale, it's kind of a pseudo ETF, if you will, I guess, they're sucking up all of the new Bitcoins are being mined. The demand is higher than the mine. That's why you're seeing the price go up. Okay. It's a supply and demand thing. And, he's saying, a lot of people, we're at what, 15,000? I haven't looked at it. We're up 50% in the last 4 or 6 weeks, something like that. You're breaking out of a declining wedge from that top at 20,000. This is going a lot higher, and I think that's going to draw a lot more people into it. And like I said, the institutional money, you start throwing numbers around, people start thinking you're weird. But why couldn't it go 10x, 100x? In the scheme of $100 trillion of assets under management worldwide, that's certainly feasible, right? So, that's one of the things right there. I think that have to get the transaction time and fees really have to be dealt with for people to get more jazzed up, in my view.
Well, what's wonderful, and I'll tell you, like, for instance, so one of the assets in my portfolio is XRP. XRP, take away all the stuff Ripple's doing with their Ripple Net and the partnerships and the things that they're doing. Take that off the table. And let's just talk about the open source protocol with the actual open source digital asset XRP. Cost of production, or cost of transactions, it's fractions of a penny. I mean, it's literally nothing. Speed settles in 3 seconds. It's been around since 2012. Not one single disruption in the ledger. In other words, no vectors have been attacked and points of failure exploited. None of that kind of stuff, right? So it's secure. It's made to be a medium it's made to be a bridge between this and that. So once the market demands that speed and efficiency, the technology is already there. It just gets plug and play. Matter of fact, it's already kind of starting. There are exchanges that use XRP as the base pair, so you don't have to pay all the fees associated with moving Bitcoin into this or into that or into the other thing, or Ethereum. Okay, great. I agree with you that the end user, this last mile hurdle, where there is intuitive, easy to use, and secure user interface, dealing with private keys and sometimes a sequence of 30 numbers and letters as an wallet address is daunting to some people. But solutions are already in play. They have not got wide acceptance yet. But for instance, human readable addresses. I have a jerryvhall.crypto with a wallet that you can send up to 7 or 8 different currencies to. And all you need to put in the address is jerryvhall.crypto. There's another thing called Global ID, which is like it's jerryvhall at Global ID. Or my thing called Pay ID, which is jerryvhall at some.eu. Human readable addresses that are like email addresses are the solution for one of those daunting, scary issues. But you also have these entities like these exchanges that are putting out ACH ready debit cards that will take your digital assets and let you spend them like money. There's a tax thing that isn't worked out yet. So it's not really a smart thing to do. You don't want to use Bitcoin for your friggin' gas because you don't want to pay capital gains and the price of gas. So it's not perfect yet. But I think as the market gets larger, it's only going to get even a larger market. You and I talked off air for a second. When I look at the risk analysis that entities that are dealing with other people's money have to go through, right? They do risk analysis. They have to meet compliance standards. And at certain volatility profiles and certain liquidity profiles, it doesn't matter what the asset is. There are institutions that cannot acquire that asset until they meet the criteria. Well, as the market grows, its volatility profile will change. As the market grows, its liquidity profile will change and open the door for more funds and more institutions to come in. So it's kind of that self-fulfilling prophecy in a way. As the market cap grows, more entrants can come in. I'm talking institutionally. The more institutions come in, the larger the market gets. The larger the market gets, the more innovation gets applied to these elements like last mile, user interface, ease of use, this ubiquitous system that we just, is not like any other thing that we learn to do on our phones, these apps that we have to use. So I'm excited, man. Next couple of years are going to be really, really, really exciting.
Yeah, I think one of the things that really attracts me to it, and hard assets in general, look, these governments have really got themselves into a corner here. You're at the end, basically, of not even a generational, probably multi-generational debt cycle.
Yes.
You have situations now where they have rates at zero. You're going to have yield control policies. You're going to have negative rates forced onto people, real rates. They'll be positives yet, but because of inflation, you have a Federal Reserve that's basically Jerome Powell has knocked on your door, came in for coffee, and told you that they're going to pursue inflationary policies and that they're going to compensate for the previous years of lower inflation. And don't kid yourself when these people say, well, they won't be able to get inflation. If a central bank and a government want to get inflation, they will get inflation. Now, we're not going to go through, Gammon does a lot better work on this than I can do in an hour, but, the transmission mechanism will be, infrastructure, direct payments to people. And what really gets me, who is left, especially in the West? Look at the new crop of millennial politicians coming up. They are all populists of either a left or right sway. There's no physical conservatism. You now have, I encourage everybody on this call that's listening to this, and I keep telling people this, you can go to Macro Voices. Eric Townsend did a good interview with her. You better get acquainted with the name Stephanie Kelton, professor who is the main advocate of modern monetary theory, and read the book that she just recently published called The Deficit Myth. And you will be shocked to see it doesn't matter what I want or if I believe in hard money or Austrian economics. This is what's going to happen. And these new crop of politicians are not going to be restrained. And now they're going to be presented with a monetary theory, a way of funding government that has the stamp of approval of the intelligentsia, if you will, these professors and these thinkers, so-called thinkers, and they are going to do things that are they're going to turn everybody into a speculator, basically. So you're going to have to take responsibility. The 60-40, sitting down with your Edward Jones advisor once every 6 months, you better forget about that. And people better get educated and understand what's going to happen. And there's not going to be a lot of places to hide. And this is what attracts me to Bitcoin. It has a natural deflation, disinflation built into it because it's capped hard. Even gold, they still can increase the supply by 1%, 1.5% a year. So, yes, I don't want to get too far into those weeds, but certainly that's a main attraction. And that's why I think a lot of institutions are going there. And that's why these companies are putting their money. Why would you put your money into a currency, into even a checking account? Like, why would they do that when it's already, losing purchasing power? And your government and your so-called central bank are telling you that they're going to continue that policy. So I don't know. That's one of the main factors that really got me to take a really hard look at it.
Well, I'll tell you one of the important elements, and this isn't getting into the weeds at all. This is very contextual, and that is this. It's very simple. If you are learning to be an investor, you better know the rules of the game that you're playing in. Whether you agree with them or not is irrelevant. Understand the rules of the game. And then once you understand the game you're playing, then you can utilize your own strategies, apply your own game theory, curtail your own cognizant biases to form trade ideas that allow you to express them. But know the rule makers have made the rules. And until there is an absolute sea change in that, until something like Occupy Wall Street actually produces a result, or we do get a breed of Austrian economic majors in politics, in running central banks and things of that nature, we need to understand that there is no bound to the balance sheets that the Fed and to some degree nations feel that they can expand. Well, that doesn't bode well for us who have to operate in that economy, right? Because the only thing that offsets the inflation created by money generation is if your wages go up. So ask yourself, are your wages going up and tracking money growth, money supply growth, base money, broad money, interest rates on borrowing?
No.
Mine aren't. You know what I mean? So
No.
I need to do something else. And I think that's what's drawn us all together. You know, you've come at it. I consider you a practical tactician. You're a practitioner. You've studied, you've learned the rules of the game, and you're applying your knowledge of those rules to construct trades to give yourself a better outcome tomorrow than you would have had you not done anything. You just put your money in a savings account. Okay, great. Speaking of that, every week at the end of my show, we bring in our lady from the street, Bitrue Ave. This is a young lady. She's a new investor, relatively new, who is applying herself on a daily basis to become a little bit better of an investor so that she can produce better outcomes with her dollars for herself and her daughter. I am absolutely just overjoyed to have her at the end of each show. She always has great questions. So, John, I'd like to introduce you to Bitrue. Hi, Bitrue.
Happy Friday, everybody.
Yay.
Oh, hello. How are you?
Good. How are you guys doing?
Excellent. Excellent.
Good.
Do you have you constructed any investment questions this week for the show?
Oh, yes. As always.
Fire away. Fire away. You are going to get the big screen.
All right. The first question for John is, I heard him say earlier that he's made mistakes at the beginning of his career. So my first question would be, what mistake have you made in the past that you would advise new investors to study now that you've gotten a lot more experience and knowledge? Like, what are the one or two things mistakes that you've made that you would want new investors to know about?
One of the first thing, this is an excellent question, by the way. Appreciate it. And I've thought about this a lot and talk about this a lot. I'd say several things. One of the main things is understanding that it's a long game. Okay. This is not what people get into this and they say they'll read books like How to Make $1 Million and the stock is crazy. So they'll sign up for currency trading schemes and all these things. This is a long game. Look at the returns. Go look on Berkshire Hathaway's website. They list all of their returns. Go look on Fairfax Financial's website. That's Perm Watsa, who's the Warren Buffett of Canada. Their average returns, these are the top guys in the world, their average returns over their 30 or 40-year career are 15 or 16%, okay? And that's averaging out all the up and down years. And these are the top guys in the world that spend all their time, have all these resources. So when somebody's saying, well, I think setting your expectations correctly, understanding that, the first rule is not to lose money, and the second rule is don't forget the first rule. So you're playing a long game. You want to compound your money. You want to compound your returns. You want to minimize losses. Don't get involved in get-rich-quick schemes or things that you don't understand. Take the time. You can squirrel away resources. We have it in our nature as, humans to save more than we consume. You can get that going, and then you can educate yourself and look and make sure that you're educated and you understand and that you have a goal. The other thing I would do that I didn't do is write down your plan. What do I mean by that? Meb Faber talks about this, having an investment plan. What are you trying to achieve? What is your psychological profile? What are your weaknesses? If you're going to buy a stock, for example, and it goes down 25%, and you're going to be laying awake at night having stomach pains, eating Tums and drinking Maalox, then you need to understand that before you get involved in these things, because that's probably not going to be right for you. Some people can't do that. You have to understand yourself. So these are things I didn't do. I just charged right in. I'll give you the example. When I started messing around with this, I was 15 years old and I did options trading. And I was successful at first, which was the worst thing that could have happened. I was extremely successful for about 6 months. I made a tremendous amount of money when I was 15 years old. And this is before computers and online trading. I had to call the trades in and all these things. And I thought that I really knew what I was doing. I confused luck in a bull market with skill. And I was rapidly dissuaded of that afterwards and lost just about everything. So I think those are the main things. I think have a long game, have a plan. Don't be in a hurry, and understand. And you look fairly young to me, so it looks like you have a long career ahead of you. And just think about, if you were able to compound your money, your savings, even at, the historical narrative of the S&P, if you just put your money in an S&P 500 index over the last 50 years, I'm not saying you should do this, but I'm just saying if you had and reinvested dividends, you would have compounded your money at about somewhere around 9% a year. And that would have been tremendous, looking at where Buffett was 16% a year. So with a little bit extra work, you can get better than that. And I think, not swinging for the fences or, thinking, well, being realistic about your expectations. That was a little bit long-winded, but yeah.
That was great.
Now, Bitta, I'll tell you, I'm going to add one thing to that. John put out a video on his channel today. All right. And there's a link to John's YouTube channel in the description of this video. And the video he put out today wasn't about any one stock. He wasn't talking about oil, wasn't talking about gold. He talked about some investment principles, and he brought up a young man, Bob Farrells is his name. And he had a small list of rules that every investor should at least be aware of, if not follow religiously. It's about a 15-minute video, and it absolutely addresses your question to the T.
Awesome.
So I strongly suggest that if you do nothing else, right, nothing else after this show, you watch that video and it will answer that question. It's almost as if you already went and watched that video, came to this show, and threw up a softball for John to hit out of the park. All right. Carry on, young lady.
Well, I just love how everybody thinks I'm so young. I just, I'm going to be very happy when I'm turning.
Okay? You're so old that anybody in your age group to us is really young.
I just love it. And then the other thing that I wanted to ask is, what other areas do you suggest that new investors study that will help in the investment arena? Like most of the time, people watch the news and current events and things like that. But what specifically do you think people should really study that are new investors that will help with investment decisions?
So Charlie Munger, who's Warren Buffett's partner and really the brains behind Berkshire Hathaway, he was asked something similar by a graduating class of MBA students at Stanford. And they asked him, they asked him this question similar, and he said that read 500 pages a day. And what he meant was, he explained it a little bit more. I would suggest watching a lot of his interviews if you can, his speeches he gives. He's a treasure trove of knowledge. But you need to create a lattice work of knowledge and constantly learning. Now, the average person, we work and stuff, that's all those guys do is sit around and read and think all day. But I think, and not just about investing, about psychology, about mathematics, all these things. And then you put this information in your head, and then it starts like capillaries. It starts integrating, and you start creating ideas, and then you're starting to look at things. He went to a dinner with some people one time, Charlie Munger, and they asked him what was his key to success. And he said, he thought about it for a minute, and he said, rationality. This is the problem. I mean, you have to, all of us are biased. We have biases for all types of things. And we need to look at things logically, without passion. It's hard to do. It's something you have to wrestle with. But I think as a new investor, that's what happens a lot. I know people that back in 2008, after the market crashed and Mr. Obama became president, it was obvious that the Federal Reserve, this is an example, was going to print a bunch of money coming out of that recession. The stock market, the S&P at that time was 666 was the low, just by accident. And I know people that would not, it was obvious the market was going to recover, but they would not participate because they didn't like Mr. Obama's politics. That is an irrationality. That is a bias. That's just dumb. So I think new investors, like I said, you should constantly be, like we said at the start of the call, try to go to bed wiser than when you woke up, just by a little bit. And that knowledge will compound over time, just like money will. Hope that answered the question.
Yeah, it did. That was excellent.
Brilliantly said. I'll add one little thing to that.
Okay.
And I'll tell you, it was one of the little things that really helped me a lot. And that was this. It wasn't even about finance, but it was about, maturing as I was in my late 20s, continuing to bump my head against my own ego and my own, weirdnesses and stuff. And that was this. Learn to enjoy learning. Condition myself to enjoy learning. And once I did that, it didn't matter what I was applying that context to, whether it be nutrition or fitness, dating, money management, running my business, selling myself so that my business would grow. And now I'm applying it obviously to economics, finance, capital markets, and investment strategies. Learning to learn and enjoying it will produce incredible. I mean, it's hard to even extrapolate what actual outcomes can be achieved because everybody's different, but it's really opened up a world where, for me, my outcomes are consistently more on target and better and by design, as opposed to in the early days where a lot of things I did, I got lucky on a lot of stuff. It was not teachable and repeatable. Whereas now I can actually teach somebody to have repeatable results over and over and over and over again. Whereas before, not so much.
All right. We've come a long way.
Yes, we have. I'm looking at the clock. We got room for another one or two.
All right. I have one more question.
Okay.
So now, John, now that you have an idea of what, the crypto market, as far as whether it's Bitcoin or other altcoin, if a new investor is to jump into the market, what would you suggest, as far as, not as a, advice, but for new investors, would it be smart to put it into commodities and metals versus crypto? If they only had a very small amount of money to invest, knowing the percentage of, how volatile the crypto market is, what would be your preference, I guess I would just say?
Well, when you're talking about resource markets, they're very cyclical and they're terrible businesses. Let's just say that right off the bat. I mean, mining and extractive industries are typically wealth destructive. I mean, they're an 18th century, 19th century choo-choo train industries. Everybody hates them. They're terrible. But there's times when, like what I believe we're going into now, where they can be extremely profitable. The problem is these things are burning matches for the most part, and they're not something that you can buy and hold. I look at this crypto thing as almost, and Jerry, you can jump in here.
Yeah.
I think the analogy was perfect earlier with some of these companies like Amazon and stuff like that. I mean, it's a growth industry, shall we say? And I think going forward, I mean, messing around with resource stocks and stuff like that, I do it because I like it. I like the extractive industries. I like big machines. I've always enjoyed it. But if I was younger, I think I would devote myself to probably spending most of my time educating myself on crypto, and I just see it as being, it's almost like unlimited. I think as far as the growth that can happen in the applications, and just we can't even conceive now of some of the things I think that are going to be able to, and I can't even myself. So I'm not the right person to ask that, but I think that that's what I think resource investing at certain times can be very profitable, but you really got to know what you're doing. It's very cyclical, but I think crypto and that whole sector is just a growth industry. I think if you educate yourself and get on the right things, I mean, that's what I'm doing. I like I said, I do some angel investing, and I'm actually involved in a couple deals now with helping finance at the seed stage some companies that people are trying to do some things. But yeah, I think that's the way to go.
Can I take a stab at that, Bitter?
Yes, absolutely. I was reading the comments at the same time.
So every single one of us, whether it doesn't matter what stage we are in our progression or our learning, have to wrestle with how much do I allocate and what do I allocate it to, right? So everybody's answer is going to be different. So I'm going to answer it if I was giving you advice, because I know you a little bit. I know your situation. I know that you have a daughter. I know that you have a job. So I'm taking into account a lot of knowledge about you. So this is not a broad stroke answer for everybody. I just wanted to frame it, so I'm very specific. For you, if you put yourself together a little 150, whatever, if you can eke out $100 a month for investment out of your income, or 150, you'd be really smart allocating 33% of it to Bitcoin, putting that Bitcoin on a platform like a Nexo or a Celsius, where that you're getting an ROA as you're going to lend them your asset. They're going to return you an interest rate, but they're going to return it to you in the form of that asset. So instead of ROI, which is return on investment, you're going to get ROA, return on asset. Oh. As the capital appreciation of the asset grows, so does your holdings. The percentage interest won't change because you're getting a percentage of the asset, but the value of the asset's going up. So it's like you get a compounding effect, as opposed to just sitting there hoping the capital appreciation as it's sitting in your private wallet, right? And then 33% to the one or two top, what we would call proof of stake smart contract platforms, where all the dApps and all the innovation is going to occur. All the innovation in this space, 95% of it is all going to occur with the way to utilize smart contracts for money, tasks, procedural. I mean, everything, every supply chain, every authentication, every payment structure. These smart contract platforms are going to be the ones that do it, the programmable money. Well, they have mechanisms that give you ROA by staking them to it. You understand the Cardano or the Ethereum 2.0 model, right?
Right.
3%. And then find yourself a couple of lottery tickets that you've researched, that products, some of these tokens that are 0.001, but they have a great management team. They have a use case. They maybe even have a couple of partners. There is actually a path to profitability or utility of the token in the future. You can stock up, when those things are 0.01 or 0.001 a token, $30 a month can buy you a buttload over a period of time. And then you get the law of big numbers. And if it moves, you've really moved. You know what I mean?
I think I've checked all the boxes now. I have literally checked all the boxes now.
Right on. So I'll tell you what, we've come to this time of the show where we do final thoughts. And I just want to let you know, John, that Bitta, I, and Brady always hang out after the show and converse a little bit. We'd love to have you, but if you got to go, I completely understand that. John, final thoughts.
Final thoughts. Don't give up the ship. Never give up. That's the way I look at it. Just keep learning, and don't try not to make the big mistakes. Don't try to take big losses because they set you back. If you have a 50% loss, it doesn't take a 50% gain to get back to even. It takes a 100% gain to get back to even, and those are rare. A lot of people don't think about that. So yeah, that's my final thought.
That's huge. That is a heck of a final thought. I'll see you in the green room in a minute. Bitta, we'll see you in the green room. Let's bring on my producer, the man, the myth, Brady, for your final thoughts, sir. What say you, young man?
Oh, final thoughts. You almost stole it out of my mind, I guess, earlier. You were talking about, what was it, having really strong assets that you want to rely on, and I think that was your first 33% that you mentioned. And it reminded me of this, I guess he's a he's an options trader. I'm not sure if he's a hedge fund manager. Anyway, his name is, well, sorry. I'm trying to explain my thought through this guy. Anyway, Parilla, go look at him. Jerry mentioned goalies, and you got to have your strikers. And I think the strikers that you mentioned to Bitta were the lottery tickets. And I think once you figure out that balance, not only are you capable to dissect things once you come across them with a mind of basically everything that Jerry's doing now, not only do you do that for your quality investments, but you can also do that for your lottery tickets. And if you want to take one side of the trade, you exercise that in one way. If you want to take the other side and you think the opposite's going to happen, you figure out how to make that trade. So the more we learn, the more we understand that not only are digital assets an incredibly good trade to make, but the knowledge that you get in trying to learn more and what you do with this in 20, 10, 15 years, that's the part that you can exponentially compound. I don't know. But it's a lot of learning that we're all going to have to do if we either don't want to give it back or as he said, don't give up the ship. So
yeah, that was that John hit it on the head. Don't give up the ship. I'll tell you what. Where's Brady? I'll tell you what, folks. My final thought is pretty simple. I'll never forget this. So I had the good fortune of interviewing a 13-year Navy SEAL. This guy is an absolute badass. And when I asked him, what are some of the components that allowed you to get through this thing that so many people fail? And he broke it down to simply this: embrace the suck. Embrace it when it sucks. Just embrace it. And if you're, life isn't always going to be rainbows and unicorns. We're not going to always have a 33% gain in a month kind of thing like we're experiencing right now. Those of you that have been around for a while, the last 2.5 years have just absolutely sucked. There's been some little bright spots. For the most part, it's been a depressed market, and we're starting to climb out of that. And I think a lot of people are going to jump on the bandwagon, and it'll be kind of that luck factor. But for those of you that have hung in there and you've taken the bullets and you've taken the splinters and you've learned the lessons and bumped your head, continue to learn, because this is only the beginning, right? This is going to create capital. What are you going to do with that capital? Are you learning along the way to be a good money manager also? Are you treating your own personal finances like you're the hedge fund manager and you're responsible to other people, i.e. your family, your children, your spouses, what have you? This is a heck of a journey we're on, folks. Thank you for tuning in. I greatly appreciate all the support, whether it be in the comments on Twitter, you're subscribing to the channel, leaving comments on the video, interacting with the guests on their own channels or through Twitter. Keep in mind, John's Twitter and YouTube channel are right here in the description of this. Please go check out his stuff. I think he's an absolute gem, and I think you can learn a lot from a lot of the stuff that John brings to the table. I know that I have. So that'll do it for us on Market Conversations. Till next week, everybody. Pura Vida.